this afternoon. I want to acknowledge the traditional owners of the land on whose land we are actually meeting this afternoon. I think this is probably close to the biggest event that Future Generation has done, so it is fantastic to be here at the Western. We're actually live streaming this afternoon thanks to our pro bono service provider Livewire, and it's also being recorded for later viewing on our website futuregeninvest.com.au. And also please use the hashtag for any of you that want to. It's FG Investment Forum. We encourage social media and especially Twitter. So just a little bit on what's in store for you this afternoon with this investment forum, particularly if you weren't here last year. So what you're going to hear is 5-minute presentations from 8 of our best performing fund managers with their best stock pick or investment idea. It's a bit like speed dating, but it's not one-on-one. Now it's strictly 5 minutes each. They will get a warning bell at 4.5 minutes. I'm not sure where the bell person is, but there will be notification. And it will be a case of the old red faces or on Hey It's Saturday, if any of them go over the 5 minutes. So look out, fund managers. They'll all have 1 slide per fund manager and 2 slides you'll see from our last presenter because he's presenting 2 stock pick ideas. Now your programs all have spaces for you to take some notes, so please do so during the afternoon. The slides that you see from the fund managers, I think they've been announced on the ASX, but they won't be sent to you. So if you want to, take a photograph of any of them in particular when they're up actually on the screen. There's no Q&A from the audience, we simply don't have enough time. But you can certainly contact a particular fund manager if need be on the back of this afternoon via their fund manager or via their website or by contacting me, or grab them straight after this, but you probably have to be quick to catch them. And as a special edition this afternoon, in the middle of all of the stock pick presentation, we've got a special panel session with fund manager experts that's chaired by Tony Boyd from the AFR, and it'll feature David Paradice, Geoff Wilson, and also Graham Hay. Now we're aiming to finish a few minutes before 3, and we need to do that because we've got the AGMs for both FGX and FGG immediately following this, and they've got to start at 3 p.m. sharp. So the pressure's on me to sort of try and keep us all in time. I'd now like to call on the founder and the director of FGX and FGG, Geoff Wilson, to say a few words of welcome and to present a summary of the stock pick results from the first investment forum in May last year. So thanks, Geoff.
Hey, great, thanks, Louise. Hey, look, thanks, Louise, and thank you everyone for being here, and particularly thank you the fund managers. Now, first of all, for making the effort for coming today and to share some of your IP with the investors, but probably more importantly, to when you were hit up a number of years ago and asked by someone, it could have been me or someone else that was hitting you up as part of the team, and saying, will you manage some money for free? Which is a quite unique concept in funds management land. Look, thank you very much for doing that. And everyone here who's an investor, I mean, every charity and every organisation in the youth at risk and the youth mental health charities that get benefits from what you've done, we just cannot thank you enough. So when the guys get up here today, I know we're making them sing for their supper again, but we just can't thank you enough for everything you've done. In terms of the official welcome, I actually disputed this. This was a year ago when you were here a year ago. Even though I wasn't presenting, I threw a little idea in there. Mine was Afterpay, and Gabriel he got 2 ideas, and one of his won. But I sent an email last night. I didn't see the answers, but I disputed it. That what day did you take it? Maybe I could have won if you took it at a different day. But anyway, look, they're the results of a year ago. To me, a really solid performance. By everyone. Oops, I didn't do that. Anyway, that's the disclaimer. So what have we got next? Oh, okay. That's it. Again, so I've thanked the fund managers. Now, we've got a lot of shareholders here. I want to thank you as shareholders because without you, again, this wouldn't be possible. And now because we're on a tight time frame, I'll pass it back to Louise.
Thank you, Geoff. Now, we've just got a short video before we get into it. I'm just wondering, do I need to click the clicker or is it just going to come on? Basically, we're going to show you a short video by Giant Steps, which is one of our FGX charities. This video was made pro bono by a production company, a couple who work for that company who have a child at Giant Steps School in Sydney. FGX seed funded the opening of Giant Steps School in Melbourne in 2016. Giant Steps are one of the 22 recipient charities that we actually support, and last year the total donations were 6.8 million from both companies. And we're looking to grow this donation to 30 million a year within 10 years. Our total donations in the first 3 years are $13.1 million, and we've only just begun. This year we expect the donations from the two companies will be an estimated 7.6 million. These donations wouldn't be possible but without, as Geoff said, the incredible support of our fund managers. We've got 31 of them in total, and 11 of the best performing fund managers will be presenting today. So let's get on with the stock pick presentations, but have we got that video to show? Okay.
Giant Steps is an organisation that was developed 22 years ago by a group of parents who were looking for an option for their young people with autism. Autism is a lifelong neurological disability. It is probably the most misunderstood disability because it sits in that social communication domain, and that's the major part of the disability. We have a number of corporate sponsors who are incredibly valuable, and particularly corporate sponsors like FGX.
My name is Louise Walsh, and I'm the CEO of the Future Generation Investment Companies. From a non-profit point of view, one of the biggest struggles is finding ongoing sustainable funding. Your average corporate or philanthropic funder might agree to support a non-profit for 1 year, for 3 years, maybe 5 years, but typically they won't make any commitment longer than that. It's quite short-term funding. So what we've done is we've got a group of fund managers together who've agreed to waive their fees, so they're acting pro bono, and as a result of that incredible generosity, we donate 1% of our assets each year to 14 youth at risk charities, and Giant Steps was fortunate enough to be one of those.
The demand for our services is just enormous, and in 2016, the FGX money was that investment that we needed to actually start another school.
It was incredibly satisfying to see our second donation to Giant Steps be put towards seed funding the opening of their Melbourne school. Our chairman flew down, found it incredibly rewarding to be there and to see the bricks and mortar and the start of something special.
The funding from FGX also enables more speech pathologists to work in schools, allows us to expand our skills and knowledge. Students have previously been quite withdrawn, have now come to a point where they're starting to initiate more appropriate communication. We're seeing kids who are more empowered, and that ultimately leads to happier children.
Corporate sponsors like FGX, they're an invaluable contributor. Certainly they're committed to social investment and actually improving the lives of young people with autism and mental health across Australia, which is extraordinary.
In just 3 years, the total donation has been $500,000. But we don't just want to be a funder. We feel really strongly and passionately about the organisations that we fund, and we'd like to continue with very long-term funding. These companies are set up in perpetuity. So as long as children at risk, youth mental health is an issue in our society or our community, FGX and FUG will continue to fund in those good areas. The way after we've gone.
Thank you. So look, I'm going to introduce each of the fund managers now, and look, I'm not going to read their bios because let's face it, it's a bit dull. And they're actually all, it's not that they're dull, but it's in your program. So what I've asked them is to provide me with a quirky fact or two about themselves. So you can probably at the end of it rank the quirkiness of each fund manager. But we're now going to start with Catriona Burns, and she's from WAM, who is one of our FGX fund managers. And in this case, she's actually going to be presenting a global stock since she's the lead portfolio manager for the soon-to-be listed WAM Global. Now, Katrina, as a kid, wanted to be a vet, and she spent her holidays riding horses on her grandparents' farm near Bathurst, and she was born there and spent a lot of time mustering sheep and cattle. So thank you, Katrina.
Thanks, Louise. I think you had to actually recruit one of the guys from WAM to give you a fact, so sorry about that. So thanks everyone, thanks Louise. We all know the cars we drive today have far more electronics than the cars we drove in the past. The cars of today are far more high-tech and efficient than those we bought 20 years ago. Now, in terms of that trend towards increased connectivity and efficiency, that's driving demand for many individual parts, a major one being sensors. And speaking from personal experience, on Sunday I had, the dashboard light up with some unknown sensor having gone off to some issue with, the engine of my car. So, I'm sure we've all had those experiences. A major beneficiary of that trend towards increased connectivity and efficiency is Sensata Technologies. So this company is a global leader in the design and manufacture of sensors and circuit breakers. They're a US listed business and in terms of the products they produce, it's sensors that go into passenger vehicles, heavy on and off-road vehicles, and various other industrial applications, including the aerospace industry. And a single plane might have up to 1,500 Sensata products in a plane. So, heavy use across many different industries. If you look at the cost of these sensors, it's very small in the scheme of the vehicle or truck, but mission critical. They don't produce the sensors, the commoditized sensors that might be the side mirror of your car or the bumper. Their sensors go into measuring such areas as tyre and brake pressure, transmission input speeds, chassis stability control. So these sensors can be life or death if things go wrong. So, in terms of this trend towards increased efficiency and connectivity, they're a key beneficiary. And as we get more autonomous vehicles, that's another key driver of this business. If you look at the history, so it's US listed, but it was originally spun out of Texas Instruments, which is a large US corporate. It spun out in 2006, and in 2010 it merged with Honeywell's sensors business to create the current Sensata Technologies business today. The management team has a long history with the business. The CEO, Martha Sullivan, was with Texas Instruments since 1984 and became CEO in 2010 and has delivered extremely great results over a long period. So in terms of what we look for in a business, it's strong management teams, favourable industry dynamics, strong earnings growth potential, and a compelling valuation. And Sensata really ticks all those boxes for us. to put some numbers around sensor content, say in the passenger vehicle market, if you look at the US and Europe, an average car has about $33 worth of sensors. If we move to more of a hybrid fleet, that number goes up to about $36. And whilst early days, in the electric vehicles, it looks like there'll be about $45 worth of sensors. So a great trend and tailwind there as we potentially get a change in the car fleet mix. So in terms of the results the company's delivered over time, they've had very strong organic growth and double-digit EPS growth over the past 5 years, and we think the future looks bright as more sensors go, as the sensor content per car goes up. That's only the passenger vehicle market. If you actually look at the on and off road heavy vehicle market, they're actually seeing stronger growth there. And if you look, the market there had been flat last quarter, and the company still grew 9%, and we think that market is turning. And if you look at particular applications, it might be autonomous trucks on mine sites. If you look at tyre pressure monitoring across truck fleets, that isn't standard, but is changing. So we think there's a long runway of growth, both in passenger vehicles and those heavy vehicles. So, you know, an exciting future for the company. In terms of the margins of the business, we think they can go up over time, driven by operating cost efficiencies, operating leverage that we think they'll get. They've done a couple of small acquisitions where the synergies are yet to come through, and they're driving manufacturing efficiencies across their plants. Finally, we look for catalysts that will change the valuation of a company, and we think there's two in this case. We think there's the potential for an earnings surprise, and we secondly think that capital management has been an element missing from this story. Historically, they've had an inefficient tax structure. They were domiciled in the Netherlands, which meant they paid 15% withholding tax if they did share buybacks or paid dividends, but they're re-domiciling to the UK, and the final approval should come through on the 31st of May, in which case they'll be able to start paying dividends. So in terms of ticking the boxes for us, a quality management team, strong industry positions, earnings growth potential that looks exciting, and a valuation that we think doesn't reflect that. In terms of the valuation, so if we look at the more commoditized auto parts companies, it trades in line with these players, despite having margins 2 to 4 times higher than those players. We think it should be viewed more as an industrial technology company, but yet it trades at a 40 to 60% discount to its peers in this group. So yeah, ticking the box on valuation for us, with two catalysts in the form of earnings surprise and capital management about to begin.
Thanks so much, Katrina, and I must say it's fabulous to have her back at WAM. I work out of the WAM office, and it certainly is fabulous to have a female in that investment team again now. So thank you. So next up we have Phil King, who's the CIO of Regal Funds Management, one of our FGX fund managers. Phil tells me that he coaches both his sons' soccer teams, and apparently they have not won a game yet. Now, I haven't dared ask Phil how long he's actually been coaching the teams, but I hope it's not years, Phil, that's all I can say. The other thing is that he loves watching, believe it or not, Bachelor in Paradise with his daughter. Now, I must tell you that he's not the only one, because Geoff Wilson is also an obsessive Bachelor fan, so he doesn't miss an episode, and in fact the presenter, Osher Gunsberg, happens to be a board member of Sane Australia, the FGG charity, and you just heard from Jack Heath in the shareholder presentation. So please welcome Phil to the stage.
Thanks, Louise. And just for the record, it's only this season that I've been coaching the boys' soccer teams, and we're very hopeful that when they do the proper grading and we get placed in a lower division, that we'll finally win a few games. And I don't actually like Bachelor in Paradise. It's just a way I can spend some quality time with my teenage daughter. Now, the stock I want to talk about today is the cheapest stock in the ASX 100. It trades on a PE of around 9 times, yet earnings and revenue are growing strongly. It has one of the best brand names in Australia. Qantas. Most people think of Qantas as an international airline, but this business contributes very little to earnings and very little to the valuation. The other 3 businesses are the jewels in the crown. They face much limited competition and they deserve much higher multiples. The domestic business is the bedrock of Qantas's earnings and contributes over half of the profits. Importantly, there's been some structural changes in the domestic market in Australia in the last few years. For many years, Qantas and Virgin were in a capacity war. Virgin thought it deserved 50% of the market, and as a result, capacity, which over 20 years has probably grown at 4% per annum, was growing at times at 10 to 15%. Predictably, yields fell and profits were smashed. However, a few years ago, the white flag was raised, and now the airlines are a lot more sensible, and capacity is now growing around 2% per annum. As a result, profits have recovered. Domestic yields for Qantas grew at 7% in the first half, and this growth should continue. The second jewel in Qantas is Jetstar, Australia's leading low-cost airline. Low-cost airlines around the world have revolutionised travel and allowing the leisure market to grow a lot. And the leading operators in Europe, such as Ryanair in Ireland or Southwest in the US, trade at much higher multiples than what Qantas trades at. And the third jewel is the Qantas Frequent Flyer program. It's the largest and most successful loyalty program in Australia. It has almost 12 million members. And Qantas is seeking to monetise this very valuable information database through things such as travel add-ons like hotels and cars, as well as things like health insurance and credit cards. So 3 great jewels in the crown, but valuation's not good enough for us at Regal. Like Wilson Asset Management, we need catalysts. And we see 3 important catalysts over the next 6 months. Firstly, we think analysts will be forced to upgrade their earnings in August. A lot of them are underappreciating that there's been structural changes and it's not a cyclical recovery in the domestic airline market. The second catalyst will be the payment of fully franked dividend by Qantas, which we think could happen as soon as August. It's been around 10 years since Qantas paid a consistent fully franked dividend. And as a result, the number of Australian shareholders on the register have declined a lot. And we think that once it starts paying another fully franked dividend, which in our view could be as high as 40 cents a share, which would put the stock on a 7% fully franked yield, the stock price should recover a lot more as it attracts a lot more Australian shareholders to the register. And this actually leads to the third catalyst, which is the inclusion in the MSCI index. Last November, Qantas was deleted from the MSCI index because it had too many foreign shareholders and not enough Australian shareholders, which meant that it was hitting at the 50% foreign ownership cap, and as a result, because there was no room for more foreign owners, more foreign shareholders, MSCI deleted it from the index. When that happened, the share price fell 30% over a couple of months. And so we think it could easily go up another 30% this November when it gets added to the MSCI index. So 3 jewels in the crown and 3 catalysts. Regal's very proud to support the Future Generation Fund, and I'd like to applaud what the team has done. And special credit, I think, to Geoff Wilson, who's a good guy, and he's normally a very good investor. But I was at a conference last year when Geoff said that his best investment idea in Australia was Virgin, which is Australia's second airline. Virgin loses money and the balance sheet is very weak, and I think it would have probably gone bankrupt if the shareholders hadn't supported it. Qantas has got more passengers, more planes and more profits. It trades on an international airline multiple of 9 times, and yet its 3 great businesses, which contribute over 90% of earnings, have limited competition. And as a result, we think it could easily go up 50% in the next few years, and you'll also receive a fully franked dividend at the same time. Thank you.
Thank you very much, Phil. You and Geoff can argue about that one later, I'm sure. So now I'd like to call to the stage Dom Giuliano. And Dom is from Magellan, one of our very valued FGG fund managers. Now, I didn't get a quirky fact from Dom himself, but I didn't have any shortage of suggestions from his colleagues at Magellan. So they tell me that he's travelled and lived in multiple countries during his working life, but the only place he has found napkins that he likes is IKEA. So that's certainly quirky. So he's shaking his head. It's not me, Dom. Thank you. Welcome.
Thank you. I'll have to have a chat with some of my colleagues when I get back into the office. Always wonderful to walk up onto a stage with that welcome. So good afternoon and thank you. And look, I just want to kick off with a quote which I think many of you would recognise, and it actually comes from a fellow called John Waynecker, who was actually one of the people who kicked off department stores in the United States. And his quote was that I know that half of the money that I spend on advertising is wasted. The problem is I just don't know which half. And that was back in the 1800s. And pretty much the world's advertising market ran that way for about 150 years until a couple of decades ago. And we had a couple of very interesting technology platforms come to us. And so now companies and businesses, imagine you own a business and you want to connect with your end customer and you want to target that advertising as well as possible to that person's interests and match the products that you sell to that individual. Those platforms exist now. And I'm sure that many of you are familiar with both Google and Facebook. I'll be talking to Facebook in particular. And if I think about some of my own experiences over the last little while, going through my Facebook news feed, I've come across advertising for gym gear, which was differentiated, and shortly thereafterwards I had put in front of me some sustainable footwear made of New Zealand wool. And guess what I did for both of those? I actually clicked on both. I ended up buying both of those things. This is from 2 businesses, 2 brands I'd never heard of before, pitching to me a quality product that I ended up purchasing, and I would not have known about these companies' existence before. So these guys are actually transforming the way that merchants are connecting with the end customer, you and I. The size of these companies is breathtaking, just utterly breathtaking. So Facebook has 2.4 billion users on a monthly basis, and 2/3 of those connect with Facebook every day. That's 1.4 billion, which is an extraordinary number, and you just have to ask yourself, well, why is that? Why is it just that a handful of social media platforms actually seem to hoover up the majority of the market? And quite simply, it comes down to network effects. It's the way that the ASX work, it's the way that the payment networks work, and it's certainly what underpins the economic moat, the strength within these businesses. And the fact of the matter is that I, Dom Giuliano, want to connect with my friends and relatives and colleagues on one platform. I don't want to be posting news about myself and pictures on 10 different platforms. And guess what? All my colleagues, relatives and friends are wanting to do exactly the same thing. And it's extraordinarily painful to move those relationships to other platforms. So these guys have incredible stickiness. By the way, Facebook also happens to own Instagram. Very interesting business. There's 80 million businesses which have Facebook pages. Currently, only 6 million of them are advertising. That sounds like a path to growth to me. Now, before I get onto these wonderful sets of numbers, it is worth acknowledging the risks that face Facebook. And we all know about it. The last 12 months, Facebook has acknowledged its naivety and has also acknowledged the fact that it underestimated the way that its platform could be gamed and manipulated, and that it did not sufficiently respect the privacy, the data privacy. And indeed, if you think about the three key risks which we think are facing Facebook, it's one, it's weaponizing the data. It's essentially what the Russians did in terms of interfering with the US election. Two, it's the respecting of data privacy. So think about Cambridge Analytica and the fact that quite often the end user doesn't know how their data is being used, and quite often permissions aren't being given in an appropriate fashion. And the last one is actually taxation. And the European Union is imposing tax on a range of technology companies, and it's also being hit. So you've got to acknowledge those three risks, but they are and can be overcome. Facebook is spending billions upon billions of dollars hiring thousands and thousands of people to ensure that the risks that I've just talked about are reduced materially going forwards. Now, notwithstanding these risks which I've just talked about, which are really quite serious, this company reported a couple of weeks ago their quarterly results, and have a look at the numbers on this slide. They grew revenues by 50% on the last year. And this is a company which has been growing at that kind of rate now for over a decade. They grew revenues by over 50%. And together with that, they were actually able to grow net income and earnings per share by over 60%, notwithstanding their operating costs going up by 40%. So some extraordinary numbers in terms of growth that they've achieved. Now, again, to give you a sense of the growth profile of this company over coming decades, this game is not over, not by a long shot. They currently have 10% of advertising market share outside of China, and we certainly expect them to double that over the next decade or so. How much do you pay for this? How much do you actually pay for this growth profile? Well, I hope you're salivating with one of those multiples up there. So a company that's just grown EPS by over 60%, and we certainly expect very strong growth over coming years, is trading at under 20 times earnings. You can buy the index in the S&P or even MSCI World global indices and very large indices at about 16, 17 times earnings, which have nothing like the growth profile of this company. So some very attractive growth metrics. But it gets even better than that, because everyone loves a freebie. I'm going to chuck a freebie on the page for you, and that is the embedded optionality within these businesses. So not only does Facebook own the Facebook news feed, not only does it own Instagram, it also owns Facebook Messenger, and it also happens to own WhatsApp. There's 100 billion messages being sent every day on WhatsApp and Messenger, and Facebook hasn't even started monetizing them. And they have said to the market that they are going to use those platforms to connect businesses back with the consumer and allow transactions to be undertaken on those platforms. I don't think the value of that is being captured on 20 times earnings. So a very, very attractive growth profile yet to come that is not in the price. And notwithstanding the size of the business, we certainly expect that it will be able to get much, much larger than it is now. Thank you.
Thanks, Dom. I mean, those numbers are are something else, I have to say. I mean, Facebook, it's just, it's incredible, I have to say. Oh, okay, right. There must have been I don't know what's gone on there. Anyway, so now I'd like to introduce Campbell Morgan from Sandon, one of our FGX fund managers. And Campbell is the champion of consumer rights. He is a one-man consumer advocate and searcher of companies with poor consumer service. He scrutinises each bill, each increase, and seeks to ensure companies deliver what they promised him when he signs up or buys something from them. He has on speed dial the banking, energy and telco industry ombudsman, and he lodges regular justified complaints. We suspect that when companies tell us that they are recording customer service calls for training purposes, that they are using Campbell's calls for those training purposes. Put me onto your supervisor, apparently is a commonly heard refrain when he's in the Sandon office. Please welcome Campbell.
Thanks, Louise. I think that might have been one of my colleagues from the office again. Probably no surprise I ended up at an activist fund. At last year's forum, Louise had noted a sand thematic running through a few of the presentations, including one by my colleague Gabriel Radziminski, who presented on mineral sands companies, Iluka and Mineral Deposits. And continuing on from that sand thematic, Louise had asked Gabriel if he would present in his Speedos this year if his ideas turned out to be a good one. Now, you saw from the slide Geoff put up earlier that Mineral Deposits did perform very well. But to spare you from seeing him in his Speedos, Gabriel has snuck off to Singapore for the week. I thought I'd have a bit of fun at his expense. Anyway, that's David Hasselhoff for anyone who's a fan of that great 90s show Baywatch. But enough of last year. The company I'm presenting on today is Spices, the phoenix that's risen from the ashes of Paperlinks. Spices is a paper distributor or a paper merchant. So they typically buy paper from the paper manufacturer and will on-sell it to a number of different end users such as printing companies, packaging companies, signage companies, to name a few. It's a completely different beast to the one that Paperlinks was a number of years ago. It's got a recapitalised balance sheet with a number of hidden assets. It's got slimmed down operations that are now profitable, and it's also got a new board and management team. The balance sheet was recapitalised when the old Paperlinks trust units were converted to Spices shares in the middle of last year. That has enabled the company to undertake a number of corporate and operational initiatives that they otherwise could not have undertaken. Following the recap, the company's got net cash of over $30 million, which is pretty close to half of its current market capitalisation based on yesterday's closing price. On top of that cash, it's also got a number of hidden assets that we think the market is completely missing. So as part of the recap last year, Spices released a number of documents totaling 400 pages to the market. And in one of those documents, there was a comment by one of the previous directors of the company who noted that the land they have in Tasmania and Singapore is worth a whole lot more than that carried on the balance sheet. The land they have, they've got two disused mills in Tasmania, one at Wesley Vale, one at Burnie. The one at Burnie is in close proximity to the port, which happens to be the largest port in Tasmania, so very strategically located. The land in Singapore is in an industrial estate located not too far from the city centre, so again, it's well located. We've done a lot of legwork just to understand better the value of the land that Paperlinks or Spices has. We've looked through hundreds and hundreds of real estate listings. We've spoken to a number of real estate agents. We've actually looked at a few independently released reports that have been prepared for councils just to better ascertain the value of that property. And from all the legwork we've done, we're pretty comfortable that the valuation or the market value that the directors talked about in the recap docs last year, which is significantly above the balance sheet carrying value, is an accurate one. So if we adjust the balance sheet for the market value of those assets rather than the carrying value, we estimate that the tangible book value of the company is close to 6 cents per share, which is 20% above the number last reported in the accounts. But more importantly, it's also double yesterday's closing price. So a significant amount of upside there if they can realise their assets. It's no good having undervalued assets though if the company's losing money, and whilst that was previously the case for Paperlinks, it's certainly not the case for Spices today. In fiscal year 17, the company reported its first statutory profit for the first time in almost a decade, and in the first half of fiscal year 18, their underlying earnings were up by almost 40% year on year. And they're not just generating profits, they're also generating free cash that we think will find its way back into the hands of shareholders. Why do we have confidence that this will be the case? The key reason is the makeup of the board at Spices. It's one of the rare companies in Australia where the board or the directors have actually been nominated by the shareholders. Typically, directors or incoming directors are nominated by existing directors and then voted upon by shareholders. At Spices, the shareholders were able to both nominate and vote for the shareholders, for the directors. So of the 6 directors of the company today, 4 of them are major shareholders of the company, and the chairman happens to be someone many of you will know well, Jonathan Trollope, who I'm not sure if Jonathan's around. Oh, there he is. No pressure, Jonathan. He's actually chairman of Spices, chairman of FGX as well, obviously. So with a very competent, responsible, reliable and shareholder-friendly board, we're very confident that any cash the company generates, both from asset sales and from operations, will find its way back into the hands of shareholders. So while Spices may have risen from the ashes of Paperlinks, we still think this phoenix has some rising to do. Thank you.
Thanks, Campbell. Thank you very much, Campbell. Fantastic stock to present as well, and I love the story about Gabriel as well. Now, I'd like to welcome to the stage for a panel session over the next 20 minutes or so, Tony Boyd, who will be very familiar to you as one of the most leading columnists, the AFR, and you're probably all like me in that it's a must read, the back page of the AFR, and I'm not talking about Rear Window here, I'm talking about the other side. So Tony's going to moderate the question. I'd like to welcome David Paradice from Paradice Investment Management, who is an FGX and FGG fund manager as well as a board member of FGX. Actually, I did ask Geoff Wilson as well, and also Graham Hay from Antipodes. Now, you 3 are not going to escape the quirky facts, because I must tell you about David Paradice. So I did ask Geoff, and Geoff tells me that apparently 20 years ago his parents were travelling in Peru and they were on a train and apparently started talking to a guy, and believe it or not, that was sitting near them, it was David Paradice. So there you go, it is a small world. Yeah. I also understand that there are 2 stacks of Dr. Seuss children's books in the Paradice Sydney office. One of them is Horton Hatches the Egg, a tale of a loyal elephant who never flinches from its task. Yes, they're kids' books, David says, but I admire the messages. You have to be open-minded and listen to people, otherwise an old man like me might remember something about a company 20 years ago and think it's no good and never buy it. But things change. Thank you, David. Now, on to Graham. One of his colleagues did tell me that he played bass guitar in a band touring bowling clubs in Western Sydney. So he's a former rock star.
Well done.
And lastly, Geoff Wilson. He's not going to escape either. Now, many of you may not know this, but Geoff is obsessed, mad about Broadway shows, musicals. He's just spent 3 weeks in New York, and I think every second day or night he was at a Broadway show. Now, this man knows his Broadway shows, so if ever you need any tips, more than happy to give you his mobile number, and I'm sure he'll give them to you because he absolutely follows them and he's mad keen about them. So over to you, Tony, for the next 20 minutes or so.
Thank you, Louise, and I really do feel relieved that I've escaped the quirky person sort of damnation. But my own, I will make a confession. I have been accused by my 3 sons and my wife of saying too many dad jokes. And puns, I suppose, are a way of life in newspapers because we like to, pick up on the sort of parallels between making money and losing money, I suppose. If that's, and I don't want to throw to you first, Graham, because of the losing money angle. But I thought if we just have a quick discussion about a couple of current events, and then we'll ask the gentlemen to give their stock tips. And I don't think anybody can avoid the Royal Commission. It has been shocking what has been revealed by Commissioner Kenneth Hayne and his counsel assisting, Rowena, shock and awe. And so I just thought I'd ask Graham, could you give us your perspective? What will the end result, do you think, mean for the big bank stocks and perhaps in particular AMP?
Look, yeah, I think we're all sort of taking it all in real time and absorbing the sort of magnitude of some of the information that's coming out. There will be a pretty big response, very clearly. I don't think the politicians can avoid the fallout of what's been learned. I think the one thing we have to avoid, though, is a situation of the law of unintended consequence, and that is that you end up regulating in such a way that you concentrate power back in the hands of the large institutions. I think it's in everyone's interest that the market remain very competitive and the consumers have a lot of transparency. And so we have to avoid a regulatory regime where inadvertently we take that away. So that has to be part of the thinking. But I think the other thing that comes out of this, and I was thinking about this over the weekend, chatting with my nieces and nephews, they're at high school, and I think there's a lack of financial awareness amongst young people in this country. I don't think people and governments have taken the concept of financial education seriously. We're very happy to sponsor very noble pursuits like learning woodwork in high school, or Greek mythology, or geography, or about climate change. But the one thing that will bind us all when we get to our mid-50s and 60s are the financial decisions we made in our 20s and early 30s. So I think a lot of people are making those decisions without the requisite knowledge and education on the things that they're doing. So I think the best thing consumers can do ultimately is to be informed and educated. And I think there's a role for government and the industry perhaps to play in ensuring that happens at a much earlier stage of life, rather than arriving at the age of 55 and with a realisation that I didn't spend a lot of time thinking about this in my 20s.
So would you like to see the...
Yeah.
Thank you.
Yeah, I think it's a great idea.
Would you like to see the Financial Review compulsory reading in all high schools?
Well, there you have it. Why not?
No, just the back page.
Why not?
No, well, I did actually write a book once called Australia Savings in Crisis in 1994. And it was actually listed as a textbook in the one of the universities of South Australia, and I think we actually sold a couple of hundred copies there, so it was quite amazing. But otherwise, there are a lot of remaining copies of that book. There won't be a signing outside, I'm sorry. But Geoff, what do you think? I mean, AMP now below $4. This was supposed to be the greatest diversified financial institution play in Australia many years ago. Should people buy it now?
I'm not sure if it ever was meant to be that.
Right.
I mean, the tough thing is AMP is disappointed since it listed. From my perspective.
In 1998.
Yeah, from my perspective. I mean, even the listing was a bit of a botch up, wasn't it? They're buying through Deutsche, and it was weird. I mean, the tough thing is, as someone that loves to buy $1 for 50 cents, you think, well, yeah, the sort of the two topical conversations are around that at the moment, and in terms of working against going where everyone doesn't want to go, that's where you tend to find value. There's sort of blue sky and AMP. The problem with AMP is, I've been doing some work with AMP, talking to the other guys in our office. Is there a price? Yesterday I was sitting down with some financial planners. They were taking me through, one of them used to be an AMP, working in an AMP financial planning office, and he just said, hey look, this is just the tip. he said it is rotten all the way through.
Oh, dear.
That was, we're being streamed, are we? Oh, sorry. Anyway, that was...
Yes.
Sorry,
Well,
maybe I should have kept that for later.
Okay, well, this is the difference between the Financial Review and social media. We actually have to respect the defamation laws. But go ahead.
Yeah, and so, and then I'd spoken to some people in the insurance industry, and said, hey, look, how do you work this out? And this was someone that's very well known in insurance. He said, look, I can't come up with a value for you. And to me, the risk is, I just don't know what price AMP is a buy at. There mightn't be a price.
Yes.
And Blue Sky, I think it's...
Well,
there's not a price on that one either.
Just before I give David Paradice a chance to say something, my wife was put into an AMP fund in 2001. 2003, and I don't know why it took so long. She asked me to look at a statement. And I said, you're paying some advisor fees here every quarter. Do you know this guy? And she said, no, never met him. And it turned out that this was just their business model, that every time a new client was signed up, they were basically paying an advice fee and not necessarily ever seeing the advisor. And that went on until 2005 when we took the money out of there. But David, what's your sort of view on all of this? You live in the United States, you see reforms over there trying to make it less conflicted advice. Are we heading down that road?
So at my place, I always say to my guys, never take any shortcuts and always try and do the right thing. And as an active fund manager, you would hope that at the moment there's a lot of money going into passive, or there's money going to where the most commission is paid, as opposed to going to the right fund manager. And at the end of the day, if that's what happens and it goes to the best performing fund managers, then it's the right thing. That's the right thing that's been done. So it's, at the end of the day, people can get away with sending money to where the highest commission is, but at the end of the day, something like this happens and everything will readjust, hopefully, and go to where the best stock pickers are. So.
Well, perhaps while we've got you here, David, you could tell us what does make a great fund manager? What is it that the qualities that you look for and that deliver, above market returns over sustained periods?
So I suppose, so the way I've picked fund managers, and we've got a few of them, a lot of the stuff has come from experience. So, I've had best fund managers are guys that are generalists. They're generally small teams, which kind of flies in the face of some of the bigger US groups. I find that when you've got a small team and people are much more accountable and they can get stocks in the portfolios, people work a lot better. I like people that focus on capital preservation, obviously, as opposed to trying to get 40, 50, 60% every year. Their focus is more on capital preservation, and then hopefully the returns over a long period of time will look after themselves. So it's really important that this specialist versus generalist people are running portfolios. So I had a guy many years ago. I employed him out of a stockbroking firm, and he focused on financial services, energy, and retail. And we were flying an aeroplane over to Western Australia, and there was 6 of us flying in this plane, and we were all kind of doing our work. And I looked around and I saw him reading the Sun Herald or some junky newspaper, and I thought, what the heck? And it was because he was focused in on a particular area. And what happened with the portfolio is that the portfolio started to go towards financial services and retail, which is his area of expertise. And so during the GFC, he went and wanted to buy, say, I think it was 3% in Rams home loans. And I stopped at that and I said, well, we'll buy 1.5. And he had halved it in day one. And that was, and then he wanted to buy some more. And of course, we had our general portfolio meeting and we were chatting about what stocks we should be buying. And he said, I really want to double this position. And it was because his focus was solely on financial services. And of course, I said, no, we're not buying any more. And of course, we had that discussion after the meeting about, I don't really belong here, do I? And I said, no, you better go. So yeah, it's about being a generalist being able to look at any particular sector and find out what's cheap.
And are you living proof that you can pick great stocks and make very good returns from anywhere in the world? I mean, I know you're in Denver. There's nothing against geography, a penalty of location?
No. I think the focus is that you don't want to try and be the biggest. The focus is more about getting good performance for your clients. So we've got this one fund that has been going for 18 years and delivered 18% per annum over that 18-year period. And we went from $200 million in 1992 to 2.2 billion in 2014. We gave back 800 million. And that was because economically wise, it wasn't the best decision for us, but we wanted to reduce our FUM so that we could continue to pick stocks, so that we could go anywhere and look at any particular stocks as opposed to, focused on the large stocks, we could focus on small stocks. So it's really important to maintain the key principle, which is looking after the clients and getting best performance for the clients, as opposed to looking after yourselves.
Geoff, obviously FGX and FGG have had to choose a lot of fund managers to get where you are now. I noticed there's not a lot of bank-owned fund managers or AMP in that list. Is that just a coincidence?
I mean, the interesting, and David mentioned about it, there's sort of the argument, and I know you wrote a fantastic article about boutiques quite a few months ago, but there's the big argument about the active manager versus the passive manager. That's the big discussion point, and all the money going to passive, and they're saying active managers underperform. But you quite clearly pointed out in your article, the boutiques significantly outperform the active manager, and then by definition the passive manager. And so what we've consciously tried to do is get the boutiques, and it's, I suppose it's different. It's the person that's employed by someone and just paid their salary and they go home at night. But I know David, in our early career, when we were both starting off in funds management, we sat opposite each other. We both had a little rented office, and there was a time I saw David in the morning, and I saw him in the afternoon. I think we might have had a meeting with the company together in the afternoon. He was a fund manager, I was a fund manager. And then I was talking to someone, and they said, I had lunch with David in Scone. And then they said, and I had dinner with David, and then another person, this is Tim Hughes, said, I had dinner with David in Scone. And I said, are you serious? Hold it, David was in the office all day. And then I'd found out he'd driven to Scone, he'd come back, he'd gone up there. But what I'm trying to say is, David is very mercurial as a fund manager, and he's everywhere. And it's sort of like the guy reading the paper. We had a young guy who worked with us. We're trying to work out if he was passionate. The boutique guys, they're passionate about what they do. It's their life, it's their business. Where if you're employed by, say, AMP as a fund manager, you're working for your salary, that's it. We had a similar situation where the guy was on the ferry reading his book. Young guy worked with us, and someone reported that back to me, and
he started a book club.
He doesn't work with us anymore. When I came in the morning, we said, what about this? It was on the front page of the Fin Review. He hadn't even seen it. He just wasn't passionate about it, what he does. You've got to be passionate, don't you?
I agree, and I think it also applies to financial journalism. What's your take on this, Graham? Do you have a...
Yeah, look, I think tying into what the guys have already said, I think institutional setting is extremely important ultimately in the way that a manager conducts their affairs. It's the contrast between employee-owned kind of boutique setting versus a large institution on a salary where career risk tends to overwhelm portfolio risk at the most critical times of markets. So I think institutional setting is very important. But the reality is all active managers will go through periods of underperformance. The Davis funds published a very interesting study probably about 5 years ago that looked at the very long-term track record of managers in the Morningstar surveys in the United States. And they showed that the guys who have top decile performance over multi-decade timeframes spent at least one period of 3 years in the bottom quartile and at least 1 year in the bottom decile at some point during their tenure as managers. And you've got to have the stomach and the institutional settings to carry on. And that's not easy. And so that comes down to lots of different personal attributes, and institutional settings are very critical in, I think, allowing you to get through those tough times.
Yes, well, my own self-managed super fund, of course, I try to, keep up with these brilliant fund managers, but it is hard, isn't it? You buy Facebook, as I did, at $125 and it went to 94, and I thought, wow, has this been a great investment? Of course, that's exactly when Warren Buffett bought the stock, and now it's 180. So he's very smart, very astute. We only have a couple of minutes. Can each of you please give the audience a stock that is going to beat all those others we've heard already? And there's been some good ones. I thought the Qantas one from Phil King was very good.
It was a pretty cheap shot, I thought, Phil. Hey? I mean, I know, and you can make money in rubbish. I'm not saying no, it's a great company, Virgin, but it actually is up a little bit since I picked it.
Yeah, look, sorry, I didn't mean to bring up Qantas, but would you like to start first, Graham?
Sure. Yeah, look, a name that's in our top 10. Controversial company of recent times is Qualcomm. It's the US company, ticker QCOM. It's the world's largest owner of intellectual property that's used in communications. It monetizes that portfolio through a licensing program. In addition to that, they're also the largest designer of semiconductor communication chips that go inside the mobile phones themselves, where they have about a 50% global market share. The stock has been a chronic underperformer over the last 5 years in the face of a rampant bull market in semiconductors, principally because the licensing business has come under attack from their largest clients, they being Apple and most recently Huawei. That dispute means that Apple are no longer paying Qualcomm until it's resolved. We think that ultimately gets resolved successfully, and soon to follow would be Huawei settling with them as well. So once you get that business back on track, we think the earnings power of this company is north of $7 a share. Currently the stock's in the mid-50s, so we have a stock that's potentially cheaper than Qantas, that owns some of the most important intellectual property in the world, and with a very dominant position in the design of chips that go into mobile phones. So also carries close to a 5% dividend yield, which is pretty unusual for a US company, let alone a large tech company. So we think we're pretty well underwritten by the income stream, with upside from some catalysts to do with the resolution of the disputes.
Very good. Qualcomm. Geoff?
Oh, I'm just checking a few stock prices. So unfortunately, mine's up a bit already. And this was 6 months ago. It was the old stock, Generation Development Group, GDG. That's an Australian one. But I'm mainly focused on global. I think an exceptional buy at the moment is Pershing Square. That's Bill Ackerman's, his hedge fund manager, is closed-end fund, trading at a 23% discount.
That's Pershing.
Yeah, as in Pershing, yeah.
Pershing.
Yeah,
okay.
exactly. Yeah. Pershing Square in New York. Yeah, it's a $4 billion hedge fund. If I was managing 20 bill, I'd be giving him a hard time. But that is just cheap. And it's got 9 stocks. And I visited them when I was in New York recently, and I was surprised how the guy who I was communicating with didn't know how many shareholders they had. So to me, there's a lot of opportunity there. I think there's a bit of arrogance.
Yes.
There, so that'll get dealt with at some point in time. So just again, buying $1 for 77 cents.
Well, they made it inactivist on the register.
Yeah. I think there is. Yeah, there's activists turning up. This is what I understand. And one of the big activists, I think Elliott, are on the register or looking at it, and we've seen what they can do potentially. And the other one, just with the US flavour, is I went to see Tiffany's in New York. They didn't give me any free diamonds or anything, but to me, there's an activist on the register there. They've got a new MD. He's been there for 7 months. I think there's a few things. I think it's very interesting. Cheapest of the luxury good brands.
So that's a real sparkler, is it? Sorry.
That joke.
Yeah. David, look, we've got to wind it up now, so just
Very
what do you
briefly,
think?
some of my guys say to me that Emeco, which is it's terrible, usually it's a terrible business, but it's providing mining services or equipment to mining companies. It's capped at $1 billion. It's got debt of about 400 million.
Is that EMECO?
Emeco, and it's got utilisation rates are very low at the moment, and it's about increasing utilisation rates. They've got a lot of free cash flow coming out of the business, which should reduce the debt. They've just been recapitalised, so it's kind of like a low point in the cycle to be buying a pretty ordinary stock.
Very good, thank you. Well, we've run out of time now. We can get back to the individual fund managers and their quirky habits. So thank you.
Thanks.
Thank you very much, Tony and the three gentlemen, the fund managers. So really appreciate that panel discussion. In fact, we'd love it to go on longer, but unfortunately we've only got a limited time this afternoon. But thank you again, and especially to Tony. He's got to get back to his day job now. So now I'd like to welcome up our fifth fund manager. It's Matthew Kidman from Centennial Asset Management, one of our FGX fund managers. Matthew very kindly gave me a few quirky facts about himself, because he sort of knew that if he didn't, he was going to get them from a few very reliable other sources, because he used to work at WAM. Matthew grew up on a rice farm in the Riverina, even though his father was a trained butcher. There were only 2 boys in his Year 6 class. Matthew was the only one who wanted to be school captain, and he missed out. Matthew has never had a 10-bagger. That's a stock that goes up 10 times in price on the share market. Perhaps today is his day. Let's find out. Now, I'm not sure where the clicker is. Have you got the clicker?
No.
No. Okay, that's the only thing we're looking for. Wait a minute. Here we go.
Thanks, Louise.
Good on you, mate.
Thank you. So how do I do that? The green one in the middle. And I'm going to start by saying this won't be a 10-bagger. Sorry about that. In fact, a few of the other fund managers, we all kind of know each other, said, what are you presenting today? And I said McPherson's, and I got a collective groan. And one guy said, you've always liked this stock. And I said, I've owned it twice in 18, 19 years. And he said, well, the 2 times I've talked to you, you've owned it. So anyway, so McPherson's is a business that has been in transition as long as I can remember. And it's in another transition now. I'll get to the end when I think you might look at buying it, and it's not quite yet, but it's in transition, and we're almost at the point where it could be a buy. So as you can see, the slide here, we give you the facts about the number of shares. It's trading on about a 10 times PE, 7.5 times EBITDA. That seems to be the thing that you measure most companies on these days, EBITDA, even though I don't quite get it. So I'll concentrate on the 10 times. That's on next year's earnings. So McPherson's have had a lot of terrible businesses over the years. They used to print the Telstra book, probably when it was called Telecom. Obviously, that wasn't a sustainable business given what's happened in life. They used to have a lot of household goods that they sold to supermarkets until Coles said, we're not going to take your goods anymore, which was half their business. And so they've always had a lot of businesses that were either susceptible to their customers, like a Coles, or they were just running out of time in terms of technology and being surpassed. But where it is today, its latest transition is under a gentleman called Laurie McAllister. And Laurie joined the business, I don't know, maybe a couple of years ago now, and he was from Sanofi, big pharmaceutical company listed in the US, I think French origins. He found his way to Australia, got a thick Scottish accent, so when you go and see him, he's always jovial, nice to talk to, makes the company visit pleasant. He lives out of Kingsgrove in an industrial site, and it's always dusty and not so pleasant. But Laurie's done a pretty good job because it's in transition in 2 ways. The business is, its balance sheet's in transition. That's pretty well done now. The company had something north of $100 million of debt, and Geoff and I bought it at the depths of the GFC when it got absolutely torched like any other small company that had a lot of debt.
Luckily, we did make money of it. That was the last time I owned it. But they've changed it now, and they've sold a lot of assets, and they've repositioned the balance sheet. So we've got about $15 million of debt now, and they've refocused the business on what they call beauty products and health, which obviously have got high growth at the moment. So they're pretty catchy. They're pretty in focus with the consumer, and they've got some products there. And you can see the products along the bottom and at the top. And they manufacture some. They distribute some for others. They distribute the Trilogy products out of New Zealand, which it was a slight competitor with skincare products. It got taken over recently at 12 times EBITDA, so a huge premium to what McPherson's. But in Australia, McPherson's distribute that product here. And what they've done, they've transitioned their client base as well. So now, not only the supermarkets take their products, but the pharmacies, the Chemist Warehouse and whatnot, are a big buyer of their beauty and wellness products. They're ramping up sales. They're growing at over 20% in that area. And they've actually now made a headway into China. And we've heard a lot about the China-facing stocks. One of those ones is skincare that has done well, one of the categories. They're into that. They've just started on that journey, and they're getting sales now, which is quite encouraging. So that part of the business is growing really nicely. Some of their other beauty products, like the Lady Jane product and the Manicare, have been around for a long time. They're very stable. They're leaders in their field. And what is the upside with this stock, besides the valuation, besides the fact the balance sheet has been fixed, and besides the fact that they've got a part of their business which is growing quite nicely? The upside is that they've got huge excess capacity in their warehouse out there at Kingsgrove. And what they need to do is to, and I'm not someone who encourages acquisitions for acquisition's sake, but they need to make an acquisition to use that excess capacity. What should it be in? It should be in the areas that they're talking about: wellness, health, beauty, and then they can use the same distribution they've got through the likes of Chemist Warehouse and Priceline. If they can pull that off, they can fit that into their warehouse. They can take a lot of costs out. You might see the blue sky come through. I think it's priced at the moment as a company no one's certain about. There's been a lot of stops and starts. I think Laurie's done a pretty good job, and I think there is blue sky. So on today's valuation, without an acquisition, I can see it at about $1.80. Now, when I put this slide together, it was $1.30. Today it's $1.42. So something's happened. They had an investor day the other day. With an acquisition that is at the right price, that fits into the category I said, that can sell into those areas, I could easily see it, pushing up against $2. It's not going to be a 10-bagger, but beyond that, if they can continue to grow, then you might get accretion over time in the share price. Now, let's go back to what I was saying before. Well, one more point before that. The thing that if they can make an acquisition, the thing that they can do is get rid of that household consumables business, which probably the one we probably all know in the audience, which is Multix. You might have seen it does foil, and it does all the plastic bags in your house. Now, if they can get an acquisition that fills out their warehouse and takes up their capacity, they might be able to sell that, which is a big chunk of their earnings, and get a decent price, which then they can reinvest into their growth areas again. So there's a lot of bells and whistles still to go, even though it's had a lot of transition. Now, when are you going to buy it? You wait until the next set of results, which will come out for June 30. I would say they'll give you an update in early July. And why I say that is because there's a little bit of confusion. They've sold some businesses over the last year. There's a lot of confusion about their numbers, about the pro forma numbers on the businesses going forward. And I think you need to have a look at that. And the market, my suggestion is the market might balk at what they see because it will be a messy result. But I think what's underneath is actually a business that is in transition, that might get it right this time, and it might be a good entry point into that market. Thanks, Louise. And I also just like to say thanks very much to Louise and the team. They're terrific. They don't make us do anything. They just say, where's your presentation? Hurry up. And they do a terrific job, and the whole cause is fantastic. And a small company like Centennial is very privileged to manage money as part of the whole future generation setup. Thanks, Louise.
Want that? Thanks, Matthew. Thanks so much, Matthew. And if we're back up here next year, I'm sure you'll get the 10 bagger next year, if not this year. So all the best with that. So now I'd like to welcome Eric Starr from Elliston Capital, one of our FGG fund managers. Now, when Eric started work after university, he worked with a team and they all used pencils. So ever since then, Eric has used pencils for note-taking. He is always on the lookout for a great mechanical pencil. So there you have it. Please welcome Eric Starr. Yeah, just a green one there.
Hi, it's great to be here with you all today. So the company I want to talk about today is called Equiniti, which is a UK listed company with $1 billion market cap, listed late 2015. This is a company we've owned for 2 years now. Think of a business that has a 50% market share, number one position in an oligopoly. Think of a business that's average client length is over 20 years. Think of a business where 90% revenue visibility. Very powerful metrics. Equiniti is like the computer share of Europe. It is the largest in share registry services and employee share plans. It has, this year, been getting 80% of all IPOs listed. It's gaining share. A strong, robust, solid business. 93% cash flow conversion. What's really, really powerful about this business is that it has a whole lot of other products that it sells into that client base, that share registry client base. So it's one of the largest players in pension fund administration. It's one of the largest players in KYC software services, complaints resolution management services, such that the average client pays for 7 services. A very strong, powerful business. What did we like about it when we first bought it, aside from all of those metrics and the positioning of the business, is that it just listed and it was trading at a very low multiple. We couldn't understand why. We went and met with the company a couple of times. We just couldn't work it out, and all we could hear was that they're going to lose a couple of clients. Well, the reality was it was priced to lose a lot more than a couple of clients. And what's been great for us is since we've bought it, they've had a client retention rate of 100%, and they've actually gained share. So the share price has obviously responded really strongly. What's really interesting now is that they have recently made an acquisition, just closed in February this year, where they've purchased the 3rd largest US share registry business. Why is that exciting? They bought it in an uncontested bid from Wells Fargo. It's the Wells Fargo Share Owner Services business. It's been growing at single digits, but as you can imagine, inside of a huge corporation, it's been a small player. So what is the opportunity here for Equiniti? The opportunity for Equiniti is to take their technology platform and put all the clients from the Wells Fargo platform onto theirs. There's significant cost savings to be had from that and a better service to be provided. It then has huge cross-sell and upsell optionality. So what do I mean by that? All these other services that they've been selling to their UK clients really successfully over many, many years can be sold into the US market. And I think what's really important here is if you have a look on that slide, they may be the number 3 player, but they have got some of the biggest, best known companies in the US. So the opportunity, if management delivers here, is actually pretty enormous. The ability to increase the services that they buy is really huge. Massive embedded optionality. What's really exciting to us is we don't feel that you're paying for this at all. When you look at the valuation of Equiniti relative to global peers, it's trading at a material discount. And then when you look at the upside optionality from this acquisition, and when you look at the track record that management has for execution, which to us is a really, really important variable, what you get here is a really solid, strong, defendable business at a material discount with huge upside optionality. We think over the next 2 years, you could make north of 50% and you're carrying a dividend along the way. Thank you for having me here today.
Thanks, Eric.
Thanks.
Good on you. Thanks. Thanks very much, Eric. Great to have you here and for your support of FGG. Now I'd like to introduce Ryan Riedel from Cooper Investors. And Cooper Investors are a very incredibly generous fund manager. They're involved in both companies, FGX and FGG. Now, Ryan, had a bit of trouble getting any quirky facts out of him. I had to even quiz him when he arrived today. He's certainly a Bombers fan. He's got a fetish for colourful socks, but I don't think they're that colourful today. And he's certainly, when he's not chasing around his two boys, he loves a round of golf. So please welcome Ryan today.
Thanks, Louise. The socks are toned down today, but hopefully the stock presentation is a little more interesting. So the company I want to present to you today is one that has a fantastic customer value proposition because it allows retirees to downsize into affordable resort-style living and at the same time release a big pile of cash that can go into the bank account. Now that wonderful home that you see up there, that's part of a secure, low-maintenance community that includes facilities such as a bowling green, a Schmidt clubhouse that has a heated swimming pool and an indoor cinema, and there's even a man cave out the back for the blokes. So there's something here for everyone. So what does it do? Lifestyle Communities is an owner, operator and developer of affordable seniors housing in Victoria, targeted at the over 50s market. Now, one of the things that we like about this stock is that it's what we call a niche growth company that sits in a cluster that we refer to as the ageing population. And it's in the sweet spot of two emerging trends, being the ageing baby boomers and the demand for affordable housing. And our investment proposition for the stock is centred around a unique self-funding business model, exposure to a long-term structural growth story, and the fact that it generates low-risk, inflation-protected rental income streams. And we also think it's a big positive that the co-founder and CEO owns 11.5% of the stock. So we sleep better at night knowing that he's got $60 million of his own money invested alongside shareholders. So this company operates in a really tight circle of competency. It's the only one of its peers that is solely focused on the development of residential land lease communities. And its business model is simple. Residents buy a new home typically priced at 75 to 80% of the local median house price. They then pay an ongoing weekly rent from their pension and then a deferred management fee when they finally exit the community. But the real secret sauce for this company is its ability to self-fund significant growth without the need to ask shareholders for additional equity. And it can do this because the cash that it receives from the sale of these new homes can be recycled into building the next community, which in turn adds to the growing annuity income stream. And that's that beautiful chart up there. We love it. We think it's like a stairway to heaven. And hopefully that explains to you why we think the economic engine of this business is so attractive. So in terms of value latency for this business, it comes down to the fact that the addressable market size is set to expand significantly in coming years. And here's why. Firstly, demographics. This grey tsunami that's coming is going to be a massive industry tailwind. 700 Australians are retiring each day, and the number of people aged over 65 is expected to more than double over the next 30 years. Secondly, only 1 to 2% of older Australians live in one of these communities. which compares to a more mature market like the US, where it's closer to 6%. So penetration rates can go up significantly from here. Thirdly, 10 to 11 growth corridors have been identified in Melbourne and Geelong, each with the potential to house multiple communities. So this business doesn't need to go outside of Victoria anytime soon for growth. And finally, the demand for affordable housing. And we think these guys are well positioned for two reasons. Firstly, incoming residents release on average $129,000 of equity from the sale of their old home. And this is significant because over 70% of the retirement age population has less than $100,000 in super. So this is a massive kicker to their back pocket in retirement. And secondly, that weekly rent that I talked about earlier is only 20% of the aged pension after you factor in rental assistance. And this is well below the rental stress threshold of 30%. And we think this is important because almost 2/3 of Australians aged over 65 are going to rely on the aged pension as a source of income in retirement. So in summary, these value latencies give us confidence that this business can add 1 to 2 communities to its portfolio every year for the foreseeable future, which is not insubstantial given that they only have 16 communities today. This helps us build a pathway from the current share price of $5.35 to easily over $7 on a medium-term view. And in the meantime, we're going to collect a growing, fully franked dividend. Thanks for your time.
Thank you so much, Ryan. Great stock, great presentation. And now, finally, for our final stock pick presentation, we heard from him in May last year at the Wesley Centre. I'd like to introduce Ben Griffiths from Eli Griffiths Group, one of our FGX fund managers. Ben began his career on the trading floor as a trading floor operator at the old Bond Street ASX. On the day of the October 1987 crash, it was a very early introduction to the destructive power of markets when fear takes hold of investors. They say no one rings the bell at the top or bottom of the market, but he heard it ring that day when many investors panicked out of blue chips they had faithfully held on to for years. It turned out to be a great time to have bought and not sold. Ben has never forgotten those hours on the trading floor. Please welcome Ben.
Thanks, Louise. Okay, thank you. When Louise invited me to come along today, I did say, well, we have got 2 funds that are constituent managers within the Future Gen lineup. We have the Eli Griffiths Group Small Companies Fund and the Eli Griffiths Group Emerging Companies Fund, which is about 12 months old. And I said to Louise, I'll come on, but I am going to talk to 2 stocks. But she said, strictly within 5 minutes, if you don't mind, young man. So I'm doing as I'm told. David Paradice wasn't kidding when he mentioned before on that fireside chat that a good small cap manager is a manager, or a good fund manager, is a manager that lifts up rocks, keeps moving, does the work, and literally doesn't rest. Today I want to present 2 stocks to you. The first one is in our Emerging Companies Fund. I'm going to take you underground today, ladies and gentlemen. No need for hard hats at this presentation. Mastermyne Group. Mastermyne is a specialist underground mining contractor providing operational and maintenance services. It was founded back in 1996. Essentially, the business is now able to take advantage of the growing number of new projects in the coal industry that are coming online. Most in the room will recall that the coal industry from about 2011 through to 2016 went into a little bit of a funk. There wasn't much activity going on. There certainly was a reining in of investment, and that made for tough times for Mastermyne. Today, I'm happy to say, and you can see the logos on the right-hand side, Anglo, BHP, Rio and Whitehaven. Each of those groups are important customers of Mastermyne. I'm especially excited when I hear that there's about $1 billion worth of underground coal mining and above ground, but principally underground coal mining work that will be up for tender, and Mastermind will be doing their darndest to participate in that work. They could only do that with a healthy balance sheet, and not long ago the company was able to re-energise its balance sheet with an equity raising. So now the company is very well positioned to capitalise on its strong reputation and use its balance sheet to great effect. What we also like about this particular company is it's not just us that are shareholders hoping that things come good. The senior management and the board represent about 20% of the outstanding shares. So they are, as they say, they have skin in the game. They're coming along for the journey with us. They've done the rough stuff. They went through the miserable times of 2012 to 16. We got on quite recently, so we'll take the upside if that's all right. I'm delighted to announce that the company returned to profit back in the first half of 2018, and that solid earnings trajectory, as far as we can discern, appears to be on track. I mentioned before it's an important shareholding for us in our portfolio, and we hold great confidence on its near-term outlook. But it's like one of those stocks that there'll be a time to sell this name as well. You won't always want to own a mining contractor or a mining service provider, but right now we're in a sweet spot. So from underground coal mines on the east coast of Australia, let me take you to the health and wellness theme that Matthew Kidman just touched on a minute ago. He's running around with McPherson's and the way in which they're tapping into it. I'm looking at a food group here, Freedom Foods. I'm sure most of you in this room here will recognise those two icons, Australia's own organic and So Natural. These are just two of the stable of food products that Freedom Foods sell. Interestingly, the group started its life in Tarrant Point, southwest Sydney, and has since expanded, having invested quite substantially in new facilities in Victoria, as well as new facilities in Western Sydney. The company is a fully integrated producer, which means it takes part in the production, the marketing, the sales and distribution of a range of natural foods, the two on the screen I mentioned, and a number of plant and dairy beverages. It does lay claim to being Australia's largest UHT, or ultra high temperature processing, following this plant investment. Meanwhile, that company, as it's grown, as it's invested, has built a highly experienced team of seasoned managers and an executive that we would rank as up there as amongst the most astute in the small cap landscape today. Just like Mastermind, this company has also recharged its balance sheet, got itself in a position now where it can either make acquisitions or can actually support the company's expected growth rates. Again, it's an important shareholding for us and a great lesson where you don't have to own these stocks at the lows and then ride them to whatever the high might be. It's often safer as an investor to join the journey halfway, even join the journey what looks like it's late in the piece. So in both Mastermind and Freedom Foods, we weren't there at the lows. We weren't even there 20% from the bottom. We are recently new owners, but are sufficiently confident with the outlooks for both groups, from underground to health and wellness in China, which is really where this company is going to build its bones. Southeast Asia is an enormous market. Food security, whilst it's current, will certainly play into their hands. Thanks very much for your time.
Well, thank you very much, Ben, for that and for your two stock picks to finish us off this afternoon. So look, please join with me in thanking all of the presenting fund managers this afternoon for their stock picks, as well as Tony Boyd from the AFR. We will be sending you an evaluation survey because we really do want to know what you think about this event. Now, before we close, just by way of quick show of hands, do you want to see this event again in 12 months' time? Do you like what you're seeing? And would you recommend it to a friend? So we want to make sure you bring that friend next year as well. So please be brutally honest when you get the evaluation surveys, or email me directly. Now, we please encourage you to stay on if you're a shareholder for the FGX AGM, That'll be starting in about 5 minutes' time, and that will be immediately followed by the FGG AGM starting at 3:30. We look forward to presenting another investment forum next year, first half of next year, and please make sure you sign that petition. The petition to maintain the current dividend imputation system. It's on the homepage of the Wilson Asset Management website now to do. I've actually done it during the break. It's actually so easy to do, it's not funny. Plug in your name plus your postcode. That's all you have to do on the front page. And it's also on the Future Gen homepage as well. So thank you very much again, and we'll see you next year.